All right, Canadian inflation has dipped below the target 2% level in November, but with plenty of headwinds facing the economy, what's the outlook for 2025? Joining us now to discuss is Leslie Preston, Managing Director and Senior Economist at TD. Leslie, thanks very much for joining us.
My pleasure.
Okay, so let's start with the inflation report, which showed that headline CPI did dip below 2% in November. What are your key takeaways?
Yeah, certainly good news for consumers who've dealt with very high inflation over the past couple of years. The good news, though, is dampened somewhat by the fact that we didn't see any further progress on the Bank of Canada's core measures that they use as a guide to headline inflation. Those were running 2.6, 2.7% year on year in November, right where they were in October. So the bank targets a range of 1% to 3%, with 2% being the target. So we are seeing a little bit of stickiness when it comes to those core inflation pressures.
Okay, so how does this set things up for the Bank of Canada going forward?
Well, we do think the Bank of Canada is going to continue to reduce interest rates. Some of the other good news from the inflation report is we are seeing shelter cost inflation decelerating. So we do think there's enough downward momentum in those core inflation measures that the Bank of Canada will continue to cut rates, their next rate setting date being at the end of January. So we'll be looking for a 25 basis point reduction there. But we do think the Bank of Canada is shifting to a slower pace of rate cuts over the next year. You know, they've gotten to the upper end of what they consider that neutral range, an interest rate that's neither stimulating nor restricting the economy. So they're kind of in a probing phase where they're going to be, we expect them to cut and then wait a meeting, see how the economy reacts. They don't want to, given inflation is showing some resilience, they don't want to tick off another leg higher in inflation or, you know, see how the housing market responds as well. So I think from here on in through 2025, it's going to be a more gradual 25 basis point cut, waiting a meeting and cutting again.
Especially coming off those jumbo rate cuts that we saw last time. Where do you see the terminal rate potentially being? I know you mentioned that there's going to be potentially another cut in January. Where do you see the terminal rate?
225 for Canada is where we have it getting by the end of 2025.
Okay. Now, the inflation report mentioned the threat of the Trump tariffs, which were also a big feature of yesterday's fall economic statement. What's your reaction to what the Trudeau government has said about that or released?
Well, I think really how the government manages the relationship with the United States is a very key part of the economic outlook over the next year. You know, we did see the 25% threat from incoming President Trump was tied to border security. You know, we did see some moves on that on the fall economic statement yesterday. It's going to be very important to try to prevent sort of that worst case scenario of the 25% tariffs being put on. So that's a very big priority for the government over the next year.
Okay, and do you see much potential economic impact from what has been announced at the fall economic statement?
Yeah, I'd say at the margin it is a stimulative budget. We did see deficits both in the outgoing fiscal year and the next couple of fiscal year. Certainly the outgoing fiscal year a fair bit larger, and over the next couple of years slightly larger deficits. It's not a huge economic stimulative, but at the margin it is stimulative to the outlook. Of course, you know, the big political uncertainty is we don't know how much of this will get implemented, you know, depending on how long the current government lasts. You know, we do have the GST holiday already in effect. So, you know, we do have that. But in terms of other measures, it's a bit uncertain. We were pleased to see the continuation of the accelerated capital cost allowance measure put in, which you know, helps it be more affordable for Canadian businesses to invest, which is, you know, so critical as we need to compete with the United States.
Okay, so with all that in mind, what's your base case for the Canadian economy in 2025?
Well, we are looking for the Canadian economy to gain a step next year. We're tracking growth in 2024 of around 1.3% in terms of real GDP, and we expect that to rise slightly to 1.7%.
And what's driving that?
Yeah, what's driving that is the significant monetary policy easing we already have in the system from the Bank of Canada. We do expect housing, which has been a drag for pretty much 2 years now, to start coming back. More activity in the housing sector, consumers. So, 1.7% growth is not a huge growth number. It's still lagging the United States, where we see at 2%, but still an improvement over what Canada's seen over the previous couple of years.